So we paid a little bit more than that because of the potential, but we still had to buy based on what the actual market was. And that's a lot of what newbies kind of the mistake that they make is they're so focused on cap rate, but going in that's really all they look at. But what you really have to look at is where's the building going to be in 6 months to a year after you bought it.
Hey, Cory Sperle, how you doing today, my friend? Welcome to the show.
Snowboarder's paradise, Russell. There's 3 feet of snow outside, but I think you're seeing the same thing I am.
Yeah, well, we're going to do a cardinal sin here, and we're going to date this recording of this. It's just before Christmas, 2022, and I look outside the window here, and we literally had 3 feet of snow overnight out here on the coast, and lower mainland of Vancouver is not designed for snow. How are things out in Kelowna, Cory?
Good. It's been a busy couple months right before Christmas. I just did a refinance on a property. Just trying to wrap up my year ends, that kind of thing. But, we're headed into this post-pandemic world. So I'm pretty stoked to get back to life as normal, or as normal as can be.
I was about this. I go, if you can tell me what normal is, please, I've got a fresh cup of coffee. Let me know what normal is right now. All right. So Cory, what I want to do is, here's the conversation I want to have today. And truly is going to be a conversation is, maybe a lot of people don't know who you are, and that was probably maybe by design. I'm not sure, but I think Cory Sperle needs to get out into the marketplace more because you have a wealth of knowledge. You have an incredible amount of experience behind you. You have a credible amount of information that you can share with an audience of people. And so for people that maybe don't know who you are, why don't you give us the little bit of the nickel tour of the backstory of Cory Sperle and what led you up into this rock star real estate investor today?
Well, I don't know if I'd consider rock star, but thanks for the plug, Russell. I've been basically a turtle in third gear, very kind of tiptoeing my way into investing. I started in the year 2000, with a house hack in Saskatoon, Saskatchewan, where I'm from. And from there, I think I joined REIN around 2003. But I was very slow learner. I was following, a lot of mentors, big names out there, obviously like yourself, Don Campbell, Thomas Byer, and just kind of learning, just taking my time. So I started investing in single family, moved up to duplexes, and then I very quickly moved into multifamily. But I was very, kind of shy in front of the camera. I didn't do a lot of social media posts. I didn't do a lot of, emailing, that kind of thing. I started to raise capital privately from friends and family to get into other deals. So, I quickly transitioned into multifamily around 2004. I co-invested in a deal, and then I bought my first building in 2008. And since then, I'm now in my 11th multifamily purchase. And it's pretty much just this year, I think in almost January 2020, that I finally started getting out of my shell a little bit and doing some social media and, sharing my story and letting people get to know me a little bit, kind of opening up, right? Right. But it took a while.
Yeah. So 20 years later, you're an overnight success.
Yeah, I guess you could say it that way.
So thank you. That I know that was truly the nickel tour, and I think there's an awful lot, literally from buying your first place in 2000 to 11 buildings in 2022. There's an awful lot of stuff in between those 20 years that we can truly unpack there. So gang, before we do dive into the really thick end of the weeds here, just as an FYI, this is 2 guys from Saskatchewan. We may have a Saskatchewan joke once in a while. We may talk about bunny hugs, and we may talk about, Vico milk, and we may talk about a few of those kind of things too. So we may talk Saskatchewanese, which you won't understand. Only us guys from Saskatchewan can understand. But whereabouts were you born and raised in the beautiful home province?
So I'm from Unity, Saskatchewan. So if anybody's familiar with Saskatchewan, it's actually near the Battlefords, kind of the Lloydminster area. More accurately, if you drive from Wainwright to Saskatoon, you're going to drive through it. Very small community, farming community, 2,500 people. It's also coincidentally where I bought my first multifamily building. It was a 12-plex that I bought for $29,000 a door, if you can believe that.
Do you still own it today?
No, it actually turned into a burr. I didn't really know what I was doing when I started, so I took on this building after I had just started a full-time job, just had a brand new baby. It was 400 kilometers from Edmonton, and I had no property manager. So I really don't know how I managed to turn that into a winning deal, but it ended up being what's known as a BRRRR today. So I ended up selling it in 2011. 3 years later, we doubled our money, sold it for around 60 a door. But no, but I wish I had held it because it was a really, really good property.
Nice, nice. All right. Well, so let's have here's the conversation I want to pivot into. And before we do get into the nitty gritty on multifamily and transitioning from single family to multifamily. You have your finger on the pulse of some different markets across the country, right? You live in Kelowna. You also invest out in Alberta. What are you seeing in the two markets? So and we don't have to go into really in depth, but what are you seeing in Kelowna? And then also, what are you seeing in the markets that you're investing in Alberta right now? Like, what are you just seeing on the top line surface?
Was the Okanagan where I'm living. And, the market here is obviously, it's still incredibly strong. I mean, we had a huge run up during COVID. I think prices have subsided a little bit in the past, few months, like, with the rapid rise of interest rates. But, the market here is still very hot from what I've seen. In an investment climate for multifamily commercial, it's probably pretty tough. I spoke at Kamloops a couple of weeks ago. The markets there is probably more favorable for investors. But, British Columbia in general, we have the landlord tenant laws here are not exactly in favor of the landlord, which is why I mostly prefer the prairies. But I actually just got a letter from my property manager this morning in Edmonton, and as you know, Russell, in Alberta, it's been 7 years of pain and suffering. And now, we seem to be coming out the other end. Saskatoon is even better. We've had a massive in-migration. We have a lot of people from Ukraine coming in. I've actually given like 3 rent increases in the last year. So I anticipate in the next, 3 to 5 years on the prairies, the markets are going to be incredibly strong. Rents are still really low compared to 2014 levels and compared to the rest of the country. So I think there's a lot of upside there for investors.
Yeah, and I'm seeing for example, in Calgary is kind of like this little island in Canada right now, and it's going gangbusters. What did I see? The rent over the last 12 months was like 23% rental increase over the last 12 months. And honest to goodness, it's just starting. I believe that's my personal opinion. And even at that increase in rent, it's still one of the more affordable markets in the country. And especially when you get up to Edmonton, Edmonton's even more affordable for rent up there, especially when you compare it to the incomes that the people earn as well. Okay. All right. So appreciate that quick update on those two different markets. What's your take quickly on what happened in British Columbia recently about the changing of strata? They changed some bylaw or changed some ruling of the strata that there's no longer age restriction. There's no longer restriction on rentals. Do you think that's going to be a big nothing burger, or do you think it's going to impact the rental market and with more supply? What's your take?
Yeah, that's a great question. I think any little bit helps in this market. I think a lot of what contributed to the, really scarce rentals was the short-term rental market. The Airbnbs, they've since scaled back on those a little bit, and, people aren't spending the money that they used to. But the strata one is going to be interesting, for a couple of reasons. First of all, the ones in Kelowna that I've seen most of, they're the 55 plus. And to my understanding is those ones aren't going to be affected. It's going to be the 19 plus ones. But definitely, as an investor, it might have the effect of actually increasing price on those units, because now you have people buying them for investment as well. But I think it should alleviate, the rental market a little bit. Definitely things like this help. The other one that's happening, you might talk about this as well, but I think in January, they're changing the laws so that you can get out of a contract. There's a 3-day grace period for multiple offers, which might alleviate some of the pressure. But, in Kelowna, they're also building a ton of units here since I've moved here. So, hopefully some of this starts to take the pressure off rents. But I think they're going to have to do a lot more before rents actually come down.
Yeah. And one of the things they haven't, in my personal opinion, they haven't fundamentally addressed completely yet is, just because you maybe can rent a property as a landlord in BC doesn't mean you want to, or right? With the rules are just horrible and still in many respects. And in any good business, you sit there and you look at your costs are rising, on an annual basis, and the only thing you can put through is 2.5% increase for next year. Like it doesn't take too long before that starts eroding to your margins next to nothing. And why would anyone want to be a landlord? Truly.
Yeah, definitely. The housing markets where you see the housing crisis on the news are the ones with rent control. Now, just going back to what you said about Calgary, Calgary was the exception with rent increases. We've seen a flood of people coming from BC and Ontario, and rents have actually risen, like you say, like 23%. It's still $1,000 for a one bedroom in Edmonton, where it's 2,000 pretty much everywhere else in the country. The only exception to that rule, I would say, with rent control and low rents is Winnipeg. So for some reason, Winnipeg does have low vacancy, but their rents haven't shot up super high yet. So, I can usually lump the fact of rent control and scarcity in with super high rents. Because you look at a rent roll from a building from BC or Ontario, you see like $1,000, $1,000, then you'll see like 623, 525, then 1,200, 1,300. In Alberta, we just raise rents on all units at the same time. But I'm not sure how Manitoba is, if they're doing anything different, or maybe just people aren't moving there. But that seems to be the only exception, Russell.
Well, yeah. So appreciate the insight. Like you truly have a national perspective. Like myself, you have clients and coaching clients and students across the country, and so you really have your finger on the pulse of most markets across the country. All right. So pivoting back in the conversation here. So when you bought your first place in the year 2000, where were you living? What job were you doing? What was the first purchase that you had made at that time?
Yeah, so growing up in Saskatchewan, rents were low. In the late '90s, I graduated from tech school, instrumentation, and I got my first jobs in the mid '90s. And in the late '90s, I finally got a decent job. I went to work for Cameco, the uranium company in northern Saskatchewan. So it was like winning the lottery, right? Because suddenly I had disposable income. I never had disposable income before. Everything I made went to expenses. And right around that time, I think I also read, Rich Dad, Poor Dad, and kind of clued into the fact that, hey, I need to get assets going. I need to start buying property. So, yeah, I picked up my first house in 2000. I think I was in my late 20s at the time. It was around $120,000, which was a fortune at the time, right? 8% interest rate. But I rented out the basement. It was a house hack. So that really helped stabilize the income on that first project. And it really kind of awakened, I guess would be a good word, to what was possible with real estate.
Yeah. No, and then you said you went in kind of a traditional route. You bought a single family, you house hacked, and then you eventually bought a duplex, multi units. What was the inspiration for you to go from single family with multiple residential units up to a full on apartment building? What was kind of the inspiration for you?
So at the time, I had just joined RAIN. So I was on my RAIN Space forum, and I was looking at, they had a section on there for joint ventures, for people that were pitching their deals. And at the time, I moved to Central Asia. And so I was really unable to invest myself, and go out and look at properties and buy properties. I was a non-resident of Canada. So I thought, well, this is a great way to invest passively. And some of the most richest deals that I've seen, were multifamily deals. So that's how I did that. So I ended up investing in one in 2014, with Thomas. And I think we ended up, it was also a very strong market in Edmonton, right? 2003 to 2007. So, he sold the building in 2008. I think I made, 200% return or something crazy. And then I was just all into multifamily after that. Once I figured out the value was tied to the income, the NOI, and I was sold. I was all in at that point.
Yeah. And so you went the route of, and quite honestly, this is a very recommended route to go, is so you did the route of doing a joint venture where you were the capital partner of joint venturing with the real estate expert. And you had an intention that you were doing this is, I'm going to learn this process. I want to learn the system from somebody who's been down this path before me. And lo and behold, you actually made money by you learning the process at the same time.
Yeah, that's exactly right. And I recommend that route for anybody starting in commercial, just because of the cost of mistakes at the multifamily level can be fatal. And, thankfully that first deal, I went in with someone who was more experienced, who was also able to take me under their wing and, really, really train me on the aspects of it. I honestly don't think, Russell, I would have done JVs raising other people's money myself if I had not have done that first. That was a
Right.
really good stepping stone to get into my first two deals, which I funded myself. So I kind of made my own mistakes with my own money first before I got into raising capital.
Okay. So you did a deal with an experienced investor before, kind of showed you the ropes and went there. When you went pivoted from kind of, I would call maybe a joint venture, a transaction with training wheels, if in essence, right? To one that you did on your own. How did you find that? Did you have the confidence to do it yourself, or what was kind of that process that you went through to really kind of spread your wings and go on your own?
Well, I'll be honest. I fell flat on my face first. So from around 2005 to 2006, I think I probably put a dozen offers on buildings. I had three of the buildings under contract. Prices were still really cheap. They were 35 to 50,000 a door in Edmonton. I had buildings under contract, and for some reason, I didn't close on them. So I really, looking back on that, I wasn't ready. But I did tremendous damage to my reputation, to joint venture partners. I really started too early, and I just was not ready. So by the time 2008 came, I was pretty much ready to give up. And then this opportunity came up to do it on my own. And I went that route instead. Obviously looking back now, if I had closed on those three buildings in 2005, I probably could have did it. It would have been a very different story today, but it definitely wasn't a straight line. I mean, I took quite a few steps back before I managed to even take even a single step in the right direction, so to speak.
No, so you said a lot there. So I'm going to acknowledge one thing for sure is, a lot of people say in multifamily is sometimes you don't attempt multifamily, you do it. Sometimes it can damage your reputation. But at the same time, really the only way, in my personal opinion, that it would be a loss is if you quit and stop doing it, right? But you just persevered through it. You maybe took 4 steps backwards, but you just kept going forward. And today, if I had your mortgage broker and your property manager and your realtor and people that on your team that you thought you had damaged reputation with, if I asked them, they'd probably say, man, he's one of the most upstanding guys. I'd trust him with my mother's money, right? So you didn't quit, which is the key thing, right?
That's a great point, Russell. It's no matter what you do for damage, if you think because you're inexperienced, it's never too late to turn things around. I mean, we learn from our mistakes and we grow from there. And you're right. I mean, I remember those people. I can remember the realtors. I won't mention their names, or the brokers, but I was probably the biggest joke in multifamily at the time. I was trying to get advice from people who had more experience. They were telling me what to do. All I had to do was take that advice and do it.
Yeah.
But maybe it was because of fear. Maybe it was because of some of these other things. But also the consequences of leverage on such a large scale with multifamily. And at the time, I wasn't financially strong enough to do it on my own, and even with a joint venture. So, even if I'd have bought those buildings, I don't know how that would have turned out because I didn't have that level of experience with my own money first. So
Yeah.
I don't regret the way that it went, but yeah, the team members that I kind of burned back then are my strongest allies today.
Yeah, and sometimes it's it's how you finish, it's not how you start the race too. And to be honest, sometimes how do you get experience? You get experience by, pardon my language for a second, but by shitting the bed, right? And how do you get experience? By stepping on a landmine and having a bomb drop, right? from just having some things that go wrong and making those mistakes. And truly, I firmly believe the only way you can really lose is if you stop and if you quit. So that's really the key thing here as well, is to just keep going there. But here's the thing is, from someone sitting here going self-proclaimed, I didn't know what I was doing. I made all the mistakes. I burnt a lot of bridges. I was the joke in the multifamily space within this area. And who's laughing now, by the way, with 11 buildings under his belt or transactions? And I imagine you're looking for more. You're looking for more.
Yeah, I do. I do mentor other people too. And this question has come up. I had a couple students that they did the same thing. They had a deal that they didn't close on. For whatever reason, it wasn't really their fault, but just the level of, oh man, kicked in the gut, discouraged, I'm never going to buy a building. And I got to say, look, this is my story. This is what I did. Every single one of you can do this too, right? It's not going to be a straight line. You're not going to hit a home run right out of the gate. I mean, it can happen. I mean, I've seen it. If you bought something in Edmonton, 2006, sold it in 2007, didn't matter what it was, you're going to be a genius, right? But
Yeah.
most of us didn't take that path, especially if you've been around a while. There's a lot of ups and downs.
Yeah. Nice. So here's a question line that I'm going to get into, and we're going to get into some tactical multifamily investing tips and strategies and conversation here. But if somebody is kind of sitting here and they're maybe thinking about multifamily, like thinking about going down that road, what would be advice? You're coaching me, right? Let's say I'm 4 years in. I've transacted. I know I have some acumen of real estate. I've transacted some single families. I'm looking to make that transition to multifamily. What advice would you give me of some simple next steps that I need to take in order to do this?
I've actually seen a lot of people actually, really struggle going from single family to multifamily, especially if they don't live, where they want to invest. I can think of several instances of people from the Lower Mainland that, bought into Edmonton maybe at the wrong time or under the wrong advice, and they really weren't prepared for it. And they did very well in single and, just struggled mightily when they did that switch to multi. So the first thing I would say is, get educated as much as you can, try to reach out to people that know more than have done this before. And most of us, we're very happy to share and give advice. I mean, we're very open-minded people. If someone sends me a deal and says, what do you think? I'm going to be honest. I'm going to tell you exactly what I think of the deal, how much I would pay, the areas I would not invest in. Definitely want to start making contacts. Property management companies are a good one. I think property management companies know the market better than any realtor ever does because they manage the properties. But I'd say it's not something you really want to jump into. You want to get a good reputation with a mortgage broker, figure out how the lending process works. A good mortgage broker will give you a loan opinion before you make an offer. Most investors, they'll put an offer and, expect to get 75 loan to value. And the lender comes back and says, well, we can give you 50% because they didn't, contact them before the offer. But, good brokers will do that, so preparation is key, having your ducks in a row. I mean, having the capital raised, either having them cash yourself or having JV partners lined up, being as prepared as you can before you go in to multifamily, because like you said at the beginning here, you can't attempt multifamily, right? You're either all in or you're all out.
Yeah. Yeah. So really just the if I was to summarize it is the pre-purchase preparation. And what does that mean? That means aligning yourself with the education, aligning yourself with the knowledge, aligning yourself with the proper teammates, aligning yourself with the right people. Like, for example, I'll give you an example. Let's say, and we'll go back to what the conversation we were having. So we're talking about me, and let's say I was 4 years in, I bought a few properties, and I'm sitting there going, I'm wanting to get into multifamily, and I've determined maybe Edmonton, Alberta is the place to go. Okay. Who do you use as a realtor? Do you use Chris in Edmonton?
Yeah, Chris is certainly a good realtor. I mean, there's several of them that I use. And this is the one misconception too, is that you work with only one realtor.
Yep.
Unfortunately with multifamily, you have to be more open-minded. It's good to start with one realtor. I mean, Chris is fabulous to work with, but I mean, honestly, he probably gets, I don't know how many calls a week from new investors. Hey, I want to buy a building. I want to buy a great cash flowing building. And he maybe has 2 listings, right? So he's going to do the best he can. The best he can do is just be on his list. When something comes up that meets your needs, be prepared to write an offer. But, what I would suggest starting out is, hit Avis and Young, hit CBRE, contact, a lot of these other realtors and just get on their email lists or their newsletters. So when stuff comes out, you're going to see it, and start watching MLS, maybe start building a bit of a database, of projects, that you're interested in, the niche you want to invest in. It depends on, where you want to. If you want to do student or blue collar, maybe you want to do North Edmonton. Maybe you want to have military tenants, right?
Yep.
So you want to pin down your niche first and then start building your team around your niche.
Wow, you said a mouthful. We're going to come back to that in a second, but I want to complete the thought process here. So here's, honest to goodness, here's what I would do if I was me in that standpoint of 4 years in, few single families, want to get into multifamily, want to go there. I honestly, I would educate myself and do everything Cory would say, and then I would get coached by Cory. I'd be part of his coaching program, and then what I would get Cory to do would make the connection for me to the realtor, the mortgage broker, the property manager. And then all of a sudden, I now separate myself from every other email that comes through as I'm being coached. I have a person who's been down the road, 20 years experience. I have somebody that I can, I literally shortcutted the introduction and I shortcutted the learning curve by just being part of a program of somebody who's been there down the road before me, right? You stand on the shoulders of other giants is really what you do, right? Okay.
Yeah,
So
you nailed it. And when I started, I didn't have that opportunity. Sorry to interrupt there. I didn't have that opportunity like when I was starting out to be able to do that, to bounce, to access other people's networks. But that's really powerful, if you get an endorsement or a recommendation, from somebody, because I actually don't do that. If I get emailed and called all the time, say, hey, can you recommend a property manager? Can you recommend a broker, a realtor? And if I don't know the person, I just won't do it because I don't know who they are, right? I'm not going to introduce someone to my team that I haven't personally vetted myself, so, people that I know well or have gone through my program, then I'm happy to do that. And the success rate is actually quite high on that front, right? Because then instantly you're kind of at the front of the line and you get the best opportunities than you would otherwise.
Yeah, that's what I do. The same thing as when I have all the time people come and want a connection or a referral, but I won't do it until I have a conversation with the person. And I hard qualify them. I will really ask them some hard questions. Because here's the thing is what I want to do is my team is extremely good and extremely busy, and they unearth off-market opportunities that not everybody can have. They're not a realtor that would just set you up on an MLS drip and just fire you out just the run-of-the-mill properties. They're out there literally digging in the dirt to go find the good opportunities, and I'm not going to send them anybody. I'm going to send them some good quality people because I want them to transact and I want people to win. But at the same time, in order to earn that referral, you have to do some work yourself too, right?
Oh, for sure. It's a two-way street, 100%.
Yep. All right. So and here's what I'm going to circle back to in that conversation that you had and you started there was I 100% believe that, and this is something my business partner and I have coined, and it's not rocket science and it's not unique to us. It's the three pillars of real estate is what you buy, where you buy, and who you rent to. And the most important of those three variables is who you rent to, the tenant profile. Is that your same philosophy, or how do you start your process? Do you just look at pro forma start, or do you look at areas of cities? Do you look at tenant profiles? How do you kind of start narrowing your search, Cory?
Yeah, who to rent to is definitely critical. It's one of the things that I didn't really look at before. But now, I mean, I tend to avoid certain areas like Edmonton. I don't really invest in the inner city. I like the outskirts. I like, areas like Leduc, Fort Saskatchewan, Spruce Grove, because I'm looking for more of a blue collar tenant who has a vehicle and drives, right? And I've had the most success with that. I can minimize my turnover. So yeah, I mean, tenant profile is definitely number one. And, number two would be area. And, my two niches I really love is Edmonton and Saskatoon. I do have a slight bias towards Edmonton because I have much stronger management. Property management has been a real struggle for me in Saskatoon. It's a smaller market. There's a lot of competition, if you would believe it, from out of province. For some reason, it's like this. It's almost like St. John, New Brunswick, that no one heard about it. And now all of a sudden it's like Saskatoon, everybody wants in on it. So what we're seeing there in multifamily is almost speculation, which is great for an owner, but to try to buy something there, is difficult. So yeah, I'm looking at price per door, cap rates, but the lending rate has also become much more challenging in the last 6 months. And I'm actually looking at this, stress testing my loans a lot more. But most of all, I'm looking at upside, right? What is the market rent and how much do I have to spend in upgrades to get to that rent? And that's going to determine how much I'm willing to pay for that property. Okay. And, right now, there's actually quite a bit of buildings for sale. So investors are actually, for the first time in a while that I've seen, we can actually take our time, make proper offers and do proper diligence, right? The market is very much in balance now.
Okay. So let me just bookend that. So literally what you're looking for is you're looking for fundamentals in an area, but you're also looking for probably that spread versus what it's renting for and what it should be renting for. And that's one of the primary things you're looking for. Is that a safe summary of what you just said?
Yeah. And another great way to say it is I don't buy on cap rate, of the building, because if the rents are $200 below market, and maybe they're managing the property very poorly, their expenses could be out of control. So your going in cap rate is really irrelevant because it's going to be different 6 months after you bought the building.
Yeah.
But you still have to know the prevailing cap rate of what the appraisers are going to use and what the lenders are going to use. Right now, loans are being scaled back due to debt service, but if the building we bought in Leduc, for example, the rents were like $800, and now we're getting like $1,250, right? A year later. So
Yeah.
if we bought it based on $800, it wouldn't make a lot of sense. So we paid a little bit more than that because of the potential, but we still had to buy based on what the actual market was. And that's a lot of what newbies kind of the mistake that they make is they're so focused on cap rate, but going in that's really all they look at. But what you really have to look at is where's the building going to be in 6 months to a year after you bought it. Even longer in rent controlled markets like Ontario and British Columbia.
Oh, brilliant. And one of the things that I remember a conversation I had with, have you met Dave Steele with Western Properties Group?
No, I haven't had the pleasure to meet him yet, but I have seen some of his podcasts. I've seen some people interviewing him, and I love the Western Wealth model. They've really scaled up quickly, in the States. So it's awesome.
Well, but one of the things that he said that was absolutely brilliant, that really stuck out for me is this game of multifamily, it comes down to management, really, what you just told me. And it's one thing is in certain markets, if you can't get good management, you potentially will do a hard pass on that area. But one of the things he said was they go to an area, they identify the worst management companies in the town. They bring their own management process in, which they consider to be one of the best. And then their acquisition team targets the worst managed properties in the area. And then what they do is they just turn the management around on these properties, and they get an instant lift by just changing over management with things, because you more effectively manage it. You fill vacancies, you raise rents, you come in with your gold standard package of renovations. And honest to goodness, their entire acquisition strategy is just target those buildings that are managed by the worst manager in town.
That's brilliant. I actually did hear that before. And, it's one of the things that I should actually look at more in my markets, right? I can give you a great example. That happened to me in Saskatoon. I was with a property management company. I have a good friend. He bought an identical 24-suiter right beside mine, right? For 2 or 3 years, we both had incredible, difficulty, high vacancies. I hired a new management company, and, instantly we raised rents $100 a unit. Nobody moved out. So I refinanced that same year, and I got $500,000 higher in lift than my neighbor right beside me. And his rents are still at the same level, and he's still with the same management company. So it's amazing how much of a difference in equity upside just changing management can make, for sure.
Yeah, 100%. Now, okay, so let's talk about, so let's say you've identified an area, you've identified some upside, and you've identified maybe some properties. So what do you just do? Does a realtor just kind of send you listings and you analyze them? Do you go find your own? Do you do your own digging? What's kind of the process for acquisition in your world?
Yeah, I just do I have a lot of analysis tools, but I really just do a quick and dirty calculation, Russell. Like, I really track the expenses more than anything. And I'm up to date on that from my property manager. So on most pro formas, you'll see they'll use, 5,000, 5,200 per unit per year. Well, I'll call up my PM and say, well, what are you guys seeing right now? Well, we're up at 6,000. So now it's very simple. I just take my expenses, right? If it's $6,000 times 20 units, and then I figure out what the rents are, what I can get the rents to. And then I can figure out, what I'm willing to pay for the building from that, right? And then I just filter out the buildings that have the best upside. I don't like, small 1-bedrooms or bachelors. I would prefer, 2 and 3 bedroom units. Those buildings are a little bit rare. Obviously, the more units per building, the better. Something like 11 to 8 suiters. They're hard to manage. You don't have on-site managers, so they really cash flow poorly. So I look at like 20 suites plus. But most of all, I'm looking at, the condition of the building and, what's the upside. The common thing is you see buildings that are, need a lot of work, high vacancies, yet they still want, full market price. Right. So I've had a lot of deals I've bought that have been for sale in MLS for like a year, and I'll just make an offer for what I think it's worth. And I've gotten 3 buildings that way. So you just never know. You got to figure out what the value is that you're willing to pay, put in your best offer, and then wait and see what happens, right? But in a lot of times, the realtor will laugh at me, or the vendor will like, no way, just flat out refuse. But then, 6 months to a year later, it comes back, right? Because I've done my homework going in. and I know as a sophisticated investor what that building is worth, right?
Oh, cool. So interesting that you said that you kind of start on the expense side of things, and at the end of the day, a dollar saved is still a dollar earned, and here's the thing is, if everybody just kind of, most people probably would jump in on the income side and find out if there's something there, and let's say you're already at peak rent on there. A lot of people might just throw it out, but here's Cory coming along, analyzing the expenses with a fine-tooth comb and getting the magnifying glass out, and you might find an opportunity that somebody has passed on because they just don't dig deeper into the expense side of things. That's quite brilliant, actually. So,
Thank you.
yeah, I'm going to pivot here. I want to pivot into let's take a small case study of a property that you just recently did, and maybe I know I hate to put you on the spot, but you know your numbers pretty inside out and backwards. But let's take a peek into a case study of the Leduc place that you just purchased recently. Okay, and when did you guys put an offer? I know you and another person on this podcast, Michael Bug, was part of that as well, and you guys have done that. When did you put the first offer in? What did you buy it for? Tell us the story of the Leduc multifamily you just recently bought.
Sure. So around April of 21, I put in the offer based on what I thought, based on the rent roll, based on the expenses, without having seen the building. I mean, it had 4 vacancies at the time. They were asking $110,000 a unit. I put in an offer at 95. And I got the deal. So I got it under contract. I went and walked through the building. This was before, Mike was involved in the deal. I walked through with my property manager, and this is the most critical step of all. And he looked around and he said, Cory, you need to spend, I can't remember how much it was. It was something like $8,000 a unit to get to the market rent. And the market rent was actually lower than what I thought it was. And it was funny because he was there with the realtor, and the realtor's trying to tell us what the rents are. And, my manager's at Braden, he just looked around. He says, well, I manage this building, this building, this building, this building. And I can tell you that the rents are this, right? So, we based it on that. I went back and asked for reduction to $85,000 a unit. And I just got a flat out refusal. No. So the contract was collapsed. And this actually happened to me on previous deals too. It's like kind of discouraging, but at this point, I hadn't lost any money. This is 7 days after the purchase contract is signed. So you always want to walk through with your property manager as soon as you can after an offer, because this is the time to retrade the asset. This is the time to ask for a haircut if it's justified. And in this case, it was. So, the sellers were they responded, very negatively, but I left the door open. So 3 months later, they had it under contract again, and it had fallen apart again. So I think by this point, the deal had fallen apart maybe 5 or 6 times. So there's kind of a pattern going on here, right? So when they called me a second time, I was ready. So I said, okay, yeah, my offer still stands at 85. And we got it at 85. So that's how we ended up getting the building under contract at that price. So my PM had already walked through it. So, buying the building was very easy. We got a bridge loan. Rates were fairly low at the time. So it still made economic sense. So we did our renovations. I think it was 8 or 9 months later, we refinanced the building around $130 a door. So we were able to pull, I think, 90% of our equity, almost all of our equity out, despite, rates were already higher by the time we refinanced in July of 2022 of this year. So,
okay. So
pretty good deal.
Wow. So you bought the place. So let me just, my 6th grade Saskatchewan math is here. But I tell the joke, Cory, is I do have my grade 12 in Saskatchewan. I took grade 6 twice. Oh, hang on. Sorry, that's a joke, by the way. Okay. So you bought it for $85 a door. What kind of a renovation package? How much did you put into the property on for a renovation per door on that units?
Yeah, so I think we budgeted $250,000. Now we didn't end up renovating all the units. So I think we ended up spending, about $180,000 to $200,000. And that's because, when you give rent increases, some tenants don't move out. So the best strategy to do this is we instantly renovated the units that were vacant. We did super high-end renovations. We extended the countertops. We put in a dishwasher. We actually made our 2 bedrooms larger, because we knew we couldn't compete with other 2 bedrooms because our 2 bedrooms were small. So we took a chunk of the hall and made our 2 bedrooms like a lot nicer and bigger. So we were able to get top rents there. So then what we ended up doing is we raised rents on, I think, 6 of the units at a time. But before that, we actually we gave them notices and we said, look, we want to spend, $5,000. We want to give you a brand new bathroom. Okay. And then, the tenants, they knew the rent increase was coming, right? But we did this first. We said, okay, we're going to do the bathroom reno. So then it wasn't a surprise when we asked for the full rent increase. It was like $150 a unit. So out of those, about half of them ended up leaving. So then we ended up doing full renovations on the ones that vacated, but the ones that didn't are today paying full market rent. So we're ending up with a building that was 18 units that I think probably 70% of the units have been upgraded, but the other haven't. But we have full market rent on all the units. So that's kind of how that went down.
Okay, so just so I'm following, so let's say you, in round numbers for me, 200,000 in a reno package. What is, how many suites in that one again?
It was 17, but we were planning to do a bachelor conversion of the storage room because the storage room was big enough. So it was going to be 18 units. So I think we had budgeted 250 in total, but I think we were just under that. I think we spent around 200. So, divide that by 17 units.
So
like
that's
12,000 a door or something. I'm not sure.
Yeah, just under 11 and change. Okay, so you bought the properties for 85,000. You added $11,000, ballpark number. So you're into it for 96 a door. And you said you got it appraised. You got refinanced at 130 a door. 130 a door. So that's you raised the value of each unit by $34,000 just by doing that there on a residential appraisal type of a model and stuff like that, because as we know in multifamily, it's based upon the NOI and the income you generate and all that kind of stuff. But at the same time, that's a good investment of that $11,000 if you can get a $34,000 lift on just valuations, right? So
and a good point on that is I always say you need 2 for 1, right? So a lot of people will buy a building at 110 a door, to get an end value of 120 a door, and then spend 10 to get there. Right. But you need something for your pain and suffering, right? Like you need to get compensated for that. And the other piece to that too is there was the bridge financing that we had to use. So that added, I think it was another $80,000 to the cost as well. Right. So you have to factor that in, as well as, you have to duplicate an appraisal. We didn't have to redo a phase 1, but we had to do another building condition report. When you do a refinance, it's like a whole new purchase. So you have to add all those fees in as well. So if you're doing a BRRRR or a value add like this, you need to get the building at a substantially low price for this approach to make sense. Yeah. Especially today with the interest rates we're in. Like we have another building under contract right now, and this option is completely off the table just due to the changing lending environment. Yeah. So in essence, that $11,000, that was just hard costs of the renovation that you put in, not including a lot of the soft costs and some holding costs and vacancy costs. So that $11,000 renovation could be upwards of almost $18,000, $20,000 per door on a total cost in package, right? So you're now into it for 105 as opposed to buying it for 105 and then having to do that work. Yeah. Exactly. Okay. So if we would have paid full market price, we would have basically made nothing. It wouldn't have even cost us money. We wouldn't even have been able to refinance our equity out. Yeah. And you also wouldn't have had any money able to do the renovation work to be able to raise the rents, to be able to get the higher valuation. Or else you'd have to be going into the old cookie jar that's buried out in the backyard and, sometimes throwing good money after bad's not the answer too. Have the asset. No, you don't want to get in that situation. Definitely. Yeah. have the asset pay for the renovation, right? If you will. So okay. So you then got a new valuation. Talk to me about how does a refi in this? How does a refi kind of work? So you got the rents up, then you went and made a new application. You went CMHC. Talk to me about the refi, and then we'll complete the bow on this one purchase. Yeah. So when we refinanced at the time, the MLI Select, which was the affordable housing program, was really picking up steam. It was kind of the flavor of the year. Everybody was doing it. We were kind of told that, why wouldn't you want to do this? There's, you can borrow way more money. The debt coverage ratio is lower. But the process was, as soon as we received a stable rent roll that met our target. So we had a target going in. I think we wanted to get to like 1,100 on rents. We ended up getting a little bit higher than that. But we weren't able to do that suite conversion. The city of Leduc put the brakes on this conversion, and we're actually still fighting this. We're actually taking this up in, legal mechanisms to try to get them to approve this application, because it's like an $800 net income, $800 per month times 12 months capped out is a lot of value, right? That we're leaving behind by not having this bachelor suite. But thankfully, we were able to raise the rents higher on the other units to make up for that rent that we didn't get. So as soon as we reached the target rent roll, I think it was something like 22,000 or whatever it was. We instantly reached out to our broker. We said, okay, we're at target because we want to pay out the bridge loan as soon as we can. We're paying massive interest rates on that every month. It's interest only. If we go to the 12-month, there's a reset rate. So we're going to end up paying a higher rate. And then, things just don't go well if you take a BRRRR beyond 12 months. So we were very motivated to get that done. It was in the middle of summer. We did that. We got the approval fairly quickly. And when we were doing it, rates were around 2%. And over the 30-day period is when we had that massive spike. And interest rates went from like 2 up to like 4.5. So there was a lot of sweating bullets. We were like, man, we got to get this locked. We got to get this locked. We actually ended up having to pay down. It was called a pay down rate. So we had to pay $60,000 to get a rate of 3.5. And then the Bank of Canada bond just continued to go from there. So it was really a bit of a timing thing. But that's kind of the nuts and the bolts of how the refinance went. At the end of the day, it was good. We got the money we wanted out of it, but we didn't get the rate we wanted. And,
Right.
With these roller coaster rates, a lot of investors are going through the same thing with refinances right now.
Yeah. Okay. Now, there's a couple things there, some questions I want to ask in there as well, and it's just for education purposes here. Okay. So now someone's in there going, well, why is it important that you maybe want to get that bachelor unit, and you kind of rattled off $800 a month in rent, and that's pretty true net. Like you're not adding a lot more to the cost of it. If you have 18 units versus 17 units, the cost is razor thin marginally. So 800 times 12, right, is what you would do. Times 12 would be just, let's call it 9,600. Now, then what's the calculation to determine what the building valuation would go up? Do you take that let's call it 9,000, let's say. How do you calculate the valuation lift on that by doing that?
So you just divide that number. So let's say it's 9,000 divided by the prevailing cap rate. So at the time, it's probably 5.5%. So, if you have your calculator there, you can do that for me. But basically, for every dollar of rent, you increase the value of your building by $200.
Right.
Is kind of the rough calculation.
Okay. So does this sound right? So if I did that calculation, by adding that other unit at $800 a month, there's just shy of $164,000 in building lift.
Yeah, exactly. So $800 times 200. That's the rule of 200, right? Gives you 160 grand. So that's on one unit. Right. So the lift, the multiplier effect. This is why we do multifamily as investors, especially when you look at right now in Alberta. And I believe, there's going to be a $200-$300 rental lift in the next 3 years. A lot of people think I'm crazy for predicting that. I'm not going to lock myself into MLI Select rent control because I think I can get hundreds of thousands of dollars in upside in the next 3 years. We're just recapturing our losses from 2014, Russell.
That's right.
So I think the investors who've had patience have taken their licks like you and I have. We're still in there. Now it's time. I hate to say this, but as landlords, it's time to be greedy. Well, right? We've been on the other end of the stick for so long.
Here's the way I reframe it. I had lunch with a good friend of both of ours, not going to mention his name because he likes to be under the radar. And he just said, he goes, you know what? I've taken enough kicks in the you-know-where over the past decade. It's about high time these properties are going to start paying me now for all this pain and suffering I've gone through. And sometimes you just need to have a PhD. And I call PhD as a pig-headed determination with this kind of stuff too. And just at the end of the race, if you're the last one at the end, that's what's the most important thing as well. All right, so I'm going to pivot the conversation, and I would not be doing my job justice here. So I firmly believe that one of two things in real estate investing: you need to acquire properties, find good deals, and you need to raise capital, get capital, and match good deals up to capital. Okay. What do you typically do to fund a lot of your properties? I know a lot of the early ones you funded yourself, and you probably still fund some of them. How do you go about raising your capital in order to buy 11 buildings over the years? Because I imagine not all of it came from your own money.
Yeah, interestingly enough, this process wasn't that difficult for me. And I think it was just because, when I did that first deal in 2004, I just believed in the multifamily as an investment so strongly. I had an elevator speech lined up, and anyone who would listen, even people who didn't want to listen, I would start talk about multifamily buildings. And after a while, the people who were interested in the conversation, I quickly formed relationships with, right? I got them on my email list. I'd send them potential buildings. Obviously, my first JV was, my brother, my parents, and a good friend, a coworker, right? And then it was ended up being friends of theirs, and acquaintances with theirs. And I branched out. And I think you write about that in your book, The Circle of Influence, right? You start at the center, it's the easiest. As you branch out, it gets harder and harder. Now, my last official JV was 2017, in which I had a couple people that I hadn't met face to face, and that was the only time that I had done that. So before that, it was all people I had very close relationships with. But the deals I did since, like the 3 buildings I did, I actually partnered up with just single investors. So we just pooled our money together, including the last one, in Leduc with Mike, right?
Yep.
But now I'm at the point where I'm again looking at that circle and realizing that I have to start extending a little bit. We've reached the limits of our capital. So those conversations are starting to come in again. So now, I'm starting to reach out to investors, starting to have those conversations again about raising capital. Because multifamily is unlimited. That's the greatest thing about it, right? As long as you can keep finding deals, they lend based on net worth. So from the first deal, you just need 25% of your net worth of the mortgage. 25% of the mortgage amount in net worth, right? So if you're borrowing $1 million, you just need 250 net worth, right? It's kind of the opposite in the States. You need more net worth. But anyways, that's a side discussion. So once you get your first building under your belt, you have the net worth. Then it's easy to just cookie cutter that and buy many. But you still need the capital to fund those deals. So that's the limitation there, right?
And one of the things you're doing is you're now, you were having these conversations with anybody, and you were doing a one-on-one, which I highly recommend is the best conversation you can ever have, is if you can get a one-on-one conversation with a person. But look at us, us good old Saskatchewan boys here embracing some technology of putting a message out to a wider audience. And you just never know. Somebody might be sitting here and listening to Cory tell a story about a Leduc place. Like, seriously, if after you hear a story, now, don't get us wrong, we could tell horror story after horror story until the cows come home. Don't get us wrong. But if you heard a story that you can buy something for a certain price point, you put in some money into it, it gets lifted up to here, within a year, you pull your money back out. And then I'm assuming the Leduc place after the refi is still cash flowing quite nicely. I'm assuming that. Wouldn't that be the case?
Yeah, definitely. And, the rental market into the fall of 2022 was incredibly strong in Leduc. We had vacancy rates lower than 1%. We have the manufacturing areas of Niski there. It has taken a breather. I think I had to I didn't give a rent incentive, but I think I gave like $100 off the first month or something in December to rent a unit. But it was only because it's completely dead. I'm anticipating that's going to pick up again in the fall. There was a few more maintenance items we had to do. We had to do some repairs to the roof, a couple minor things. But yeah, we're in a good cash flow position. We borrowed 85% loan to value on a 40-year AM. So we didn't, do the full 50-year AM under the Select program. And we're in an excellent position to just continue to raise our rents, and I'm assuming we're going to have 3 to 5% rent increases for at least the next 3 years, maybe even longer. So we anticipate very strong cash flow moving forward.
Yeah. And so the point I was making and getting to is you hit the nail on the head for me is, just getting out and just sharing the story. Like, honest to goodness, when you hear that story, it's like I'm sitting here I'm reaching for my pocket, my checkbook and going, Cory, shut up, take my money. Right? Like what's not to like about it is the point I'm trying to get to. So gang, if you are, a lot of the people on my podcast are listening for you're real estate investors yourself and you want education and inspiration. So that's what we're doing here right now is we're sharing a wonderful story of education and inspiration. And there's so many things you can take from this. And here's the question I would ask you is, how are you sharing the stories of your deals and your transaction out to a wider audience? And how are you distributing your message to be able to raise some people raise their hand? They might become a deal lead for you. They might become somebody who wants to invest in your next redevelopment plan. They might become somebody who wants to invest in your next multifamily project. So do you take the time to distribute your stories out to a wider audience? And that's one of the things you're doing right now, is it not, Cory?
Yeah, I always believe in tell, not sell, right? We always want to talk about our home runs and not our struggles. But stories like this are really fabulous because it's win-win for everybody. It was great for Mike and I. I did another deal in Beaumont that was even richer. So it's really great for my investors, my partners and the tenants, the people who live in the buildings now, because even after these increases, the rents are affordable. We fixed a lot of issues in the buildings. We get comments from tenants of how nice it is now and how happy and proud they are to live there. And they're sticking around longer. Terry Parander said it best. It's like, we need rounder tenants. This is how we make our money as multifamily. We need tenants who are going to stick around. Turnover kills you. So if we make our units nice, we get long-term tenants in there. That's the path to wealth in multifamily for sure.
Yep. And what you've added to Terry's rounder tenant thing is you've elevated the rounder a little bit from Terry's tenant profile. Like, don't get me wrong, he's done very well in the areas that he's invested in. I wouldn't go into those areas because management is a key. First of all, finding a manager in certain areas is tough too. All right, Cory.
Well, a lot of them won't even go in there, and he's self-managed in Beverly. I don't know how many hundreds of units himself, like literally going door to door. And I don't know if he has a black belt in jiu-jitsu, but I mean, how he pulled that off, I don't know. But no, definitely tenant profile is key.
Yeah, and I know for a fact I've been in those areas myself. And when the Edmonton Police Service has you on dial and they call you up and they know you by first name and they talk about your gunfire in your units and stuff like that, and I'm out of town and I'm just like, oh my goodness, I don't need that hassle. I really don't. Now, one of the things you mentioned here is we went through this process that we talked about, and we talked about renovating units and managing units and doing all this kind of stuff. Just to be clear, you're not the one doing all that work, are you?
No. And, since I told you the Unity case study that I actually did do all that on myself, including like finding contractors. I didn't pick up a hammer and do any physical work, but I was doing all the project management. Now I don't do any of that. And this is the real beauty of the property management company that I have right now, because I just pay them like a project management fee. They can get contractors in there. They can do a suite in a week. Like, I can never do that on my own, right? They have such a large scope of trades. They can get it done cheaper. They can get it done faster, and they know the rental market. So for me, the process is very seamless. I basically hand the keys to the building over to them, and I talk to them maybe once every 2 weeks. And now I'm already on to the next project, right? Unless some kind of issue comes up. But that's been the real beauty of how I've really streamlined my business, and especially in the last 5 years, is I've taken all that micromanagement off my plate and just let the professionals do what they're best at.
Yeah, and especially if we're going to get into, and I think this might be a next conversation for us to have on this, is especially if you want to scale your portfolio, it's non-negotiable. You have to outsource all that kind of stuff, especially if you want multiple units. Like, don't get me wrong, it's totally great and it's a badge of honor to buy a property and you're putting all your posts out there about all the renovations you're doing and the appliances are coming and you out there painting at 2:00 in the morning. Like, don't get me wrong, the hustle is strong. I salute you, but you'll slowly burn yourself out and you will never be able to go greater than a handful of properties. If you want to grow and scale, you have to be able to outsource. And that might be another conversation for you and I to have about some of your systemizing and outsourcing of properties. Are you down for another conversation, Cory?
Absolutely. Yeah, I would love to talk. I can talk about that stuff all day long for sure.
Yeah. And I think that, in my personal opinion, I think that's even more of some of your prowess of what you're best at is the project management side of thing and just holding the people accountable. Probably you're better at that than a lot of people I know. And the reason I say that is, and I'm going to give you some kudos here. You put out one of the best annual reports that I see. When you put out to your investors or market reports, I don't know what you call them, but I've seen some of your analysis on building performances and what you do in the story and the written work of your reports that you put out. Honest to goodness, Cory, those are works of art, to be honest. You put a lot of time and effort into it and it shows, and they're one of the best resources I've seen out there. Of that. What do you call that report that you put out?
Yeah, I just do that. I just do a semi-annual report. Like it's basically just an update of my properties. So I get my reports from my property manager. Like, I actually have a scrum with them. I have a call with them. where are things at with the buildings? How did we do with rents? How did our budgets go? What did we do? What didn't we do? And then I also get like annual reports just about the markets that we're in. And then I use that to analyze, how did the vacancy go? Where do we anticipate versus where we're at today? What's the value at today? So I'm very much taking a look at not only today, what we did yesterday and how we anticipate going forward tomorrow. And yeah, thanks for the compliment. I mean, a lot of investors really like those reports. It really gives them a lot of warm and fuzzy feeling about the deals. And I don't do them as often as I used to. I mean, I used to do them every 3 months, and I just found that was a little bit too much. Especially now that I've owned the properties for some of them several years, 6, 7, 8 years. I'm finding a good frequency is about twice a year to send them an update. But yeah, they're really good reports, and people really like them.
Yeah, and that's one of the reasons why I say that is because sometimes you notice things that you're weak at, and I know that that's one of the things that I'm not good at. I'm really good at on the front end of the marketing and the bringing people in. My weakness, which I'm also not giving myself an excuse or a pass, I still can get better, is on the follow-up and that reporting and things like that. And that's why I just wanted to give you acknowledgement of that as well. All right, so Cory,
Awesome.
we literally could block off probably another 3 or 4 hours, and I'm holding you to commitment that you'd like to do another episode. Would you like to do another episode on some different topics here, my friend?
Yeah, for sure. 100%, Russell. I'm always down for an interview with you.
Right on. Okay, so but before we do transition, one of the things that I like to do is, I always like kind of wrapping things up towards the end is with some good old-fashioned inspiration. So if somebody's sitting here and they're watching this and, maybe or listening to this on podcasts and they're feeling a little, they're a little stuck, right? And maybe they just don't know what the next step is and they're not sure what to do, and interest rates, and there's a whole bunch of geopolitical things at play, and holy moly, Elon Musk, and go on Twitter and social media and everything's just blowing up. And they're just they just don't know what's going on. What would be some pragmatic, simple Saskatchewan next steps that you would offer somebody for some good inspiration to take the next step and keep moving forward here?
Yeah, I'd say just take a break. I even tell my kids, I mean, just get off the phones. I mean, we've been bombarded with negative news for 2 years in a row. Unplug and just do something like that you like. Like I'm going out to the snowboard hill, right? I'm competing in martial arts. Take those breaks. But most importantly, try to kind of cut out the negative people in your life, and not just with real estate. There are people that are going to bring you down. So, try to network more with people that are, similar to you or going in the direction that you want to go. Like yourself. I mean, start following some of these podcasts, follow those people on social. But right now, more than anything, I would say just, take a break. I mean, the real estate market's taking a break. It's a perfect time for you to take a break too. Take a break, reset, love yourself, love your neighbor, and just focus on the positive things in life.
Yep. And with that, there's your boisterous round of indifference there. I 100% agree. So Cory, I'm quite sure that my audience is going to agree when I make this next comment is people are going to go, where the heck have you been for all these years? Like seriously, like you're just coming out and you're making a big splash in the marketplace. You're making a big splash with the content you're putting out. Most importantly, you're making a deep impact on the people that you're working with, your clients, your students. I know many of them, and I was on a webinar you had the other night, and every one of them are just on fire. They're all firing on all cylinders. They're out there taking action, and I acknowledge a good coach who's being, and not just a coach. I'm going to take it a step up. You're actually a good leader, and you're a good leader in the community, and you're helping people move forward. So I just wanted to just thank you and keep up the good fight, my friend.
Yeah, thank you very much for the kind words, Russell. And yeah, I want to thank you for participating, with my group of students with your joint venture segment. Some great tips in there. I'm very blessed to have people like you that I can actually call for advice too. It's not just I am a great leader, but I also reach out to other people too when I need help too. So it's fabulous to be surrounded by all the positive energy. And I'm really looking forward to 2023.
Well, and that's a sign of a good coach is actually coachable all at the same time too. So all right, gang. So why don't we leave it there? We're right around that 1 hour mark. And Cory, we are going to continue this conversation. And gang, so first and foremost, if you want more information on this multifamily business or more information from Cory, and maybe if you want us to tell horror stories and good old fashioned in the trenches stories, we can definitely, honestly, that podcast would be a lot longer. This one we just did, because you learn more from the mistakes you make as well. So gang, just wanted to say thank you. Keep sharing the show, keep putting it out, and we'll talk to you very soon. Bye for now, everybody. You're obviously somebody who takes action if you made it right to the end of this video, so you should be rewarded with a couple extra bonuses and goodies. Number one, make sure you subscribe. There will be a button below here to subscribe so you don't miss an upcoming video. And over here, to continue your journey going forward, there'll be a hand-selected playlist and a hand-selected video, just perfect for what you're looking for. All right, gang, continue the momentum. Let's go!